And this is all about American jobs, growth for American workers. And the reason why we have the largest delegation here we've ever had is to say to the world, we're open for business, we're very attractive for business, and come invest in the U.S. And a good U.S. economy is great for the rest of the world.
That was Treasury Secretary Steven Mnuchin joining me earlier this morning to highlight the impact of President Trump's trip here to Davos. Joining me right now is the CEO of Principal Global Investors, Jim McCaughan. Jim, great to see you. Thanks so much for being here.
Great to see you, Maria.
Yeah, I mean, you have to be feeling good about where markets are. You're obviously invested. Are you fully invested?
Pretty fully invested where we have the choice, yeah.
So do you think this continues?
Yeah, I think so. I think U.S. equities remain, you know, I could get really boring and stuck in the groove on this, but U.S. equities remain be up to weight by the dips. And
by the dips.
The reason I say that is, even though it's gone up a long way since the election, that rise is fully justified by the changes in corporate taxes. And if we see decent growth for the next 2 or 3 years, equities ought to be able to go higher. I've thought of the analogy with the 98, 99 internet bubble. We're in 98, not 99. The ratings are not that high, and the fundamentals are really pretty good.
We had another investor on earlier who said he's expecting a 15 to 20% gain in stocks in 2018.
It could happen. My central expectation is probably more like 10.
Okay.
I think 80% chance it's up, and it could be 20% very easily. Maybe 20% probability one of these negative tail risks goes wrong. And we all know what those are. They're Korea, they're oil supplies from the Gulf, there may be a credit event somewhere in the world. But all those things are possible, but they're not expected. And it's you don't invest for a 20% probability. The 80% probability is recession is 3 years out, so there's still some pretty good growth to go.
So your AUM is what at this point?
Just under $450 billion.
$450 billion. You're allocating that where? What sectors or areas do you think are poised to move much higher?
Well, I continue to like U.S. equities, particularly small and mid-cap, because they tend to have the domestic earnings. And it's the domestic U.S. economy with the various things we're hearing that will get the boost this year. And which has... remember, we talk a lot about the day-to-day politics, which is really interesting. But the United States has got the most productive and most innovative private sector in the world. And that's the main draw on capital. So I expect that to continue to be the case. I actually, in contrast, think, for example, European equities, they're a bit of a sell the strength. You know, the strength may happen because of a generally good liquidity tone in market. But I think the growth for the long term is less sustainable.
Yeah, we should point out that the ECB left interest rates unchanged today, and the European economy does seem to be getting back to growth.
Yes, it is.
But you're saying sell on strength there, buy the dips in the U.S. Let's talk technology for a second. This is something you've been focused on recently. You're seeing more and more money managers buy technology in terms of tech companies so that they could organize data, that they could mine data. Tell me about that.
Well, we've been in the data science business for quite a long time. To us, it's an adjunct to traditional research. It's not a substitute for it. And we've got some long-term, pretty successful track records where there's the steady use of fundamental research coupled with some very sophisticated data analysis. We've so far done that mainly by organic growth, but I wouldn't rule out an acquisition too. I don't think we need an acquisition because we're pretty leading edge in data analysis.
Yeah, data is incredible, and the more data you can gather and mine, it will tell you more about your customers and more about what they really want.
And using machine learning, artificial intelligence, this is actually one of the biggest topics at this conference as business people talk, is how they can strategically use data science, artificial intelligence. And that's something which I think will continue to be an important driver for world economies. Probably more so than most people think. Remember, technology is quite deflationary. It keeps costs down. It makes you able to do more with your money. And that's actually pretty good, but it does avoid the inflation, and it looks a bit deflationary in the economic aggregates.
Speaking of inflation, do you worry that at some point we are going to be talking about higher wages, inflation, for all the right reasons, by the way, because the economy is growing, but would that be the catalyst to take this market off track?
It could, in theory, be, but I'm not very worried about that. In a sense, if it was going to happen easily, it would have happened already. You know, on the Taylor rule, we ought to have had a bit of inflation already, and we really haven't had it. And I think that's the key. It's technology is keeping inflation from coming in too fast. It might happen, but it will probably be pretty slow.
Yeah, it's a great point. Jim, it's wonderful to see you.
Great to see you, Maria. Enjoy Davos.
We so appreciate it. Great week to you. Jim McCaughan joining us there. We'll